Hey everyone, it's James Vagley here, and welcome to another episode of the MBA podcast. And it's episode 214. And today we're talking about money maths. If you don't like money and you don't like maths, you're in the wrong business, in the mortgage business. We need to be good at money and good at maths, right? That's what we're about. So, unfortunately, a lot of mortgage businesses are blindly going backwards financially. I actually see this too far often, too frequently. And I want to talk about the dangers of relying on trailing income. Obviously, in Australia, we have trail income. I know in New Zealand and other parts of the world, there is no trail income. So here's what we need to talk about. This is why this is important. If your business relies on trail income, so this is shouting out especially to our listeners in Australia, if your business relies on trail to pay everyone and to be profitable, this is bad. You are most likely the owner of a cash hemorrhaging business, right? I hear this a lot from brokers, that especially ones that have been around for a while, some of the more successful businesses, especially that have been around for 5, 10, 15 years, they'll say things like, if it wasn't for my trail, I wouldn't be profitable. Now that is a really bad thing, and we're going to talk about that in this episode. Now, of course, a lot of this comes down to financial literacy, and the financial literacy of most brokers, which is bizarre considering we're in the finance industry, is kind of abysmal. And that's not your fault. That's not our listeners' fault. It's just that it's not really taught. Your accountant's not teaching it to you. The industry is not really teaching it to you, right? And the number of and percentage of brokers that I see who don't really know their numbers, they don't know the key drivers in a mortgage business, don't understand KPIs and what needs to be effective to be profitable. It's scary. Now, we're in business. We're in business to make money and a profit. And the fact that a lot of mortgage businesses don't even understand basic financials, cash flows, projections, and capacity, it's kind of scary. So, and what we do find is that sometimes the more successful, especially financially, the more successful and the bigger the mortgage business, the lazier and dumber they get. That again, that's not having a go. That's a byproduct of success. Think about it. Mortgage business that's been at it 10 or 15 years, got a substantial trail, got a substantial team. They're writing good volume, but the trail's there. And it's a pretty robust business overall, but they don't realize that it's hemorrhaging money and is not overly efficient and profitable, right? Most people don't understand these things because they just look at the numbers and it seems okay. So the more successful, the bigger they are, often the worse it is. And the amount of brokers that we see, often with teams, and these are ones that are writing 5 to 15 million a month, the amount of these businesses around that don't realize that they're not really making any money, or that their business is not really viable, is kind of scary. You know, a lot of businesses out there would be better off closing the doors and just collecting their trail. So I want to challenge all of you watching this and listening to this to get smarter with your money maths. So let's kind of get into it. Now, you know, I've sort of been in positions in business before, making not much money, and I've been in positions of making lots of money. And sometimes making too much money in business is kind of a problem. You know, too much money, no sense. You know, sense and reasoning goes out the door, right? It's kind of why success and size of a business breeds kind of that lazy thinking around money and maths, because everything seems okay. But often, looking under the sheets and it's kind of hemorrhaging money. So unfortunately, what we find with a lot of businesses in the mortgage industry is that there's this thinking or assumption that things are good. You know, they're writing good volume. Yeah, I've got my trail, I've got this, I've got that. And we assume things are good, but they're either looking at the wrong scoreboard or not even looking at the score at all. And that's obviously no good thing. And again, what we find is a lot of brokers, we know this business, we know it's a busy industry, right? So there's a lot of mortgage businesses and brokers who own them who are just being too busy writing loans and running the business and seeing clients to keep on top of their numbers and to keep on top of money. And that sounds bizarre, doesn't it? Right? Like, You're in business and you're here to make a dollar and profit. Yes, you're here to help clients too, but you're here in business to make money and profit, but you're too busy doing all those things to actually worry about the money. And then when you forget about the money, money becomes a big problem, right? So we've got to think about this stuff. Let me give you some insights from having done this with hundreds of brokers over the last 20 years. So probably the biggest one is that we need to understand the difference between a mortgage business that is trail book management and a mortgage business around new loan writing. Now, these need to be separate profit centers and each must be profitable, right? Otherwise, you're kind of doing a bunch of work for nothing, right? That whole, if it wasn't for my trail, I wouldn't be profitable type of business. That is really not smart thinking. If you're a mortgage business owner and you've got a decent sized trail book, great. We need to separate and start thinking about the trail book management and new loan writing management as separate entities. And they've both got to be profitable. So if you write a new loan and you've got to pay a broker or a power broker, you've got a processing team, an office, all of these things, right? The commission you earn in terms of upfront commissions has to pay for the writing of that loan. You can't rely on the trail to pay your staff, right? Because if you think about it this way, if you have a substantial trail right now and you're not profitable or losing money on the new or the writing deals front, you'd be better off potentially just shutting your doors and collecting your trail, right? If you think about it from that perspective, it's going to start to open your eyes. Trail is going to come in anyway, right? Now, yes, trail is there for the incentive of supporting your clients and being there for your clients and helping them, right? You know, annual reviews, all that sort of jazz, right? But essentially, if you shut the door, you will keep receiving it. Now, okay, you might lose some of those clients, they'll be runoff as they refinance away if you're not serving that database anymore, that client book. But if you shut the doors, you still get it. So if you're going to put any time and resources and energy into writing loans, that has to be profitable without the trail. Now, obviously, I appreciate that when you've got a larger database and you have a significant trail, you might hire people to work on that database. There might be administration, there's annual reviews, up stamps, there's work to do on a database, right? Now, the people that work in the trail book management of clients, again, that needs to be profitable in its own right. So start doing the maths on this stuff. If you've got $1 million a year trail, then, and I don't know, a certain number of clients for that $1 million trail, how many staff does it require to just look after that book? Great. Is that profitable? Excellent. Okay. Loan writing division. I write $100 million a year, for example, in a mortgage business. And that makes me, what, 650 grand in upfront fees. And I have a team of people to write that $100 million. That has to be profitable without the trail. It does get a little bit, complex because obviously there can be overlap with the team and that some of your loan writing team can also be involved with managing the trail book, but you can apportion that out. The main thing is just to start to understand that you can't rely on your trail because you'll get that if you just shut the doors. Okay. Second thing, volume and the number of deals is basically an irrelevant method of keeping score and success. And the fact that the industry awards this, as in volume and number of deals, as a primary success measure is ridiculous. It's like having a hot dog eating competition and calling it eating success. Like, if you've got a hot dog eating competition, that's not healthy. That's not a good idea. So the person that eats the most hot dogs could be really unhealthy and not in a good place, but we're calling that a winner. In the mortgage business, we're giving awards to people that are writing the most loans and the highest volume and calling that the most successful. That is not a definition of success, right? I don't care your loan volume or the number of deals that you write. Profit and freedom are the only important metrics that I care about. I don't care about how many loans you write. I only care about what ends up in your bank account. That's profit. And I only care about how many hours you've had to work to achieve that profit. And that's the only two metrics you should be worried about as well. Forget winning awards, forget trying to write 100 million or 200 million or $1 billion or whatever it is in loans. Focus on profit and how you can make that amount of profit in the fastest way possible, making sure your clients and everybody love you. That's the name of the game, right? Profit and freedom. So a few tips about how to get in control of your money. So money maths. So what are we going to think about? So number one, understand the maths. So if you're in business, which most mortgage brokers are, right? Do the work to understand the maths, and the mechanics. Like, how does capacity work in a mortgage business? How does time work in a mortgage business? Now, we have all these tools in our business. We teach our clients these things, but you've got to understand and start dedicating time to working on the maths. Second, work with an advisor like ourselves, for example, who can show you what you don't know and what you need to know. Again, kind of mentioned at the start, far too many mortgage businesses just assume things are doing okay, and they don't actually know what success looks like. They don't know what a successful model looks like, successful profit and KPIs. So have an advisor in your corner that can actually help you understand what success should look like and help you understand when it's not, right? Number three, develop your business model. Actually have a business model, run cash flow projections, map KPIs to those actions and results. So many mortgage brokers don't actually have a business model. They don't know what their business model is and what their profit is for that business model, right? And they don't know what KPIs they need to hit to achieve a certain profit under that business model. So you've got to actually look at these numbers and get forensic at mapping it out and running scenarios. Number four, it's going to sound basic, but look at the money regularly. Don't rely on your accountant. That is the worst thing you can do. Look at your money and KPIs and stats and data every day or every week. If you don't focus on money, you won't have any. I can guarantee you. So start getting into the maths and the numbers and actually look at it, and then get in the driver's seat and drive your business to those numbers and to get the result that you're after. And then the last one is kind of sounds like an interesting one, but value money. So I want you to start valuing money. The purpose of business is money and profit. That's why we're in business. Now, it's more than okay to be client-centric, and we want to do good for our community and our family and the industry. So it's okay to be giving back and client-centric and doing all that sort of stuff. But if you're broke or out of business and not profitable, you can't help anyone. You can't help yourself, your family, your community. So I'd much rather that you value money, pay attention to it, make lots of it, and help lots of people along the way. And that's a far better position to be in. So, money maths. Stop going backwards. Stop pushing money and looking at the numbers under the rug, and instead step into the driver's seat and start getting serious about the money maths. And when you do, you'll be surprised. We've had case studies of people that were like, things are okay, I'm not really interested in pushing for the numbers and tracking things like that. And just with a little bit more focus on numbers and driving basic numbers and results, we've seen businesses double very quickly just by spending some focused energy on making things happen to KPIs, to certain profits. So there's money to be had when we understand the maths. Okay, I'm going to leave it there. There's a lot more to this. Business models, spreadsheets, data, cash flow projections. We do all that sort of stuff with our clients. It's deep work beyond the scope of this podcast, but I hope you at least have enjoyed this episode and got some insights from it. So until next time, until next week, have yourself a good one, stay cool, and of course, go get 'em. Bye for now.